My thesis has not changed for a while, which was that the recession everybody is expecting is probably playing out, but it was priced in last year. Right? The markets don't go down 75% in crypto without it pricing in the economic cycle. The equity markets fell 30, 35%. Long end of tech fell 70%. So we had it priced in last year. So liquidity started picking up in June of last year. And that's when I started adding to my ETH bets into that big sell-off in ETH, where ETH made its low. Then the confirmation of my forward-looking indicators was that October was another liquidity event where liquidity was rising, but the markets was having its last spasm. So again, I kind of added into that bet, added technology names as well, and was adding all the way through. So for me, looking forwards, we're now getting the bits that I've been waiting for.
Bitcoin hangs at $26,000, with the crypto community divided on its next move. Predictions range from $25,000 to $23,000. The recent weekend saw Bitcoin trading within a $200 range, with spikes beyond $26,000 linked to failed shorts. A weekly close below $26,000 could trigger a double top, potentially leading to $31,000. This week, the focus shifts to the Federal Reserve as officials discuss the economy. Bitcoin's sensitivity to Fed comments has lessened, but inflation policies can still sway BTC prices. Bitcoin's mining difficulty is set to decrease by about 2.4% on September 5. This aligns with a decline in miners' BTC stockpiles, particularly at F2 pool. Further price drops could stress miners and potentially lead to capitulation. Bitcoin's supply dynamics are changing, with a record 40.538% of the mine supply dormant for 3 years or more. This supply constriction could intensify competition for BTC if demand rises. Finally, mainstream interest in Bitcoin has waned, with search trends returning to pre-2020 levels. Within the crypto community, fear dominates sentiment, according to the Crypto Fear and Greed Index, with a score of 4100s, triggered by a 10% BTC drop in mid-August. Now let's begin our enlightening discussion with Raoul.
I live in the future. I'm used forward-looking indicators. So they're looking at things in advance, the economic data in advance, kind of a glimpse into the future. But now that data's catching up, which is inflation is going down. Unemployment is slowly rising. The economy is slowing down. And that means the Fed soon stop raising rates. It means that eventually they cut rates, and eventually maybe they use quantitative easing. We're also going into an election year. An election year tends to have stimulus because they want to get elected, so they bribe everybody with money. So we've got this kind of nexus of stimulus that's likely to come between the back end of this year, 2024, 2025. I've been working on something called the Everything Code as well, which I think I've spoken to the Banter audience about as well. And that's basically the idea that what the central banks are doing with quantitative easing is printing money to pay the interest on the debt from the previous kind of debt cycle. So every 3.5 years, same as the Bitcoin halving cycle, is this economic cycle driven by government debts and how they roll them every kind of 3.5 years, because they're all 3 to 5 year debts. We're about to come into the period where they have to monetize the pandemic payments, and they were massive. And they can't do it with interest rates where they are now. So what they're hoping is that they can get inflation to undershoot. They are not stupid, the central banks. They obviously know the forward-looking indicators are falling on everything, but they want an inflation undershoot because they need to be able to cut rates low enough that they can refi the debt and then put it onto the balance sheet. So that means, in layman's terms, starting from the back end of this year, the last quarter, let's call it kind of November, December period, there's going to be more cowbell. And cowbell is my kind of tagline for stimulus. That's whether it's the printing of money starts, or that starts then, or cutting of rates, because they need to be able to service the debt. There's $13 trillion of debts that come up for renewal, plus the new debt that they're issuing. So it's an enormous amount for the markets to digest, and the only way of doing it is this. Inflation is a measure against what happened the previous year. So if there was some outsized moves this time the previous year, you tend to get these squiggles as it is. The trend in inflation is lower because commodities have generally been lower over time. That was the first thing to move. But then you start getting the more stickier components, rents, wages, all of that is coming down. And that stuff keeps going. So the front end of falling interest rates is still to be baked into the cake, and that will be headline inflation should get below 2%, maybe even 0 by the end of this year. Which is like, if I can see that in my data, surely the Fed can too, which adds to that argument that the Fed know that they're trying to undershoot on inflation on purpose. So this stuff is going to keep falling because of how the calculations are well into 2024 and into 2025. Again, my calculations put core inflation at 0 or negative next summer.
Wow.
Maybe I'm a bit early, but by this time next year, core inflation is going to be at 0. It's kind of baked in the mathematical cake. So that's how I see it. So just over time, these numbers will keep coming lower. Now, if we look at the trueflation numbers, they've been bouncing around. They hit like 2.2% or 2.1%. Now they're at 2.75, 2.72, something like that. That's this comparison to what happened the previous year, what commodity markets did. But again, over time, the stickier components will just keep falling. And that mechanism of these slow things like rents and wages, they take a long time to deflate, which is why central banks tend to cut well after recession. They tend to be cutting for like 18 months after a recession because they're fighting this inflation thing, the deflation thing at that point. I think we're likely in a recession, and that'll likely show up in the data from this quarter, next quarter. So we won't see it, but I think we've been in a recession for a while. And I think when it eventually gets called, it may have even started at the beginning of the year. And you get this kind of weird data prints, then revisions. So I think the recession's happening. I mean, find me somebody who hasn't been laying off staff. I don't know anybody who hasn't laid off staff.
Don't forget to join us as we explore the unfolding events. Former SEC Chair Jay Clayton predicts inevitable approval of Bitcoin ETF. A U.S. congressman has defended the crypto industry against Securities and Exchange Commission, SEC, Chairman Gary Gensler, who stated that it is rife with non-compliance. The lawmaker's statement followed a pair of legal cases in which the judges sided with cryptocurrency firms over the securities regulator. A biography of billionaire investor Elon Musk reveals details about his involvement in the Dogecoin project and an idea to launch a social media platform based on blockchain. The book, which should be available later this month, also mentions a failed attempt by former crypto mogul Sam Bankman-Fried to help Musk's acquisition of Twitter. Arca Invest's Kathy Wood has shared her perspectives on the dynamic intersection of Bitcoin, BTC, and artificial intelligence.
Some 30% of the country's GDP. As for Country Garden, just last year, it was China's largest residential developer. Now it is battling a liquidity crisis. On Wednesday, it warned it could default on its vast debts as it reported a loss of $7 billion for the first half of the year. In a filing to the Hong Kong Stock Exchange, this is what Country Garden said. Let's bring it up for you. Said this, quote, "The company felt deeply remorseful for the unsatisfactory performance," unquote. A Country Garden is saddled nearly $200 billion in liabilities.
So let's play this through. So China's a shit show. It's quite clear. They've got a liquidity problem. They don't have enough liquidity. They've overbuilt property markets. There's too much debt in China. So what is the outcome? So there's the second largest economy in the world starting to increase stimulus. Let's flip to Japan. What Japan has been doing is interesting. They've been holding their interest rates at this 0.5% and they've just ratcheted it up. And how they've held it there is what's known as yield curve control. They buy all bonds at that price. So bond yields can't go higher. What is that? That is printing of money. So they've been stimulating. They're 265% of GDP in debt. If you increase the interest rates, you have to issue more debt to pay the interest, right? It's this massive problem. So what do? Keep interest rates roughly at your trend rate of GDP growth. So then your GDP can pay your interest payments. So everybody's doing the same. And I've gone back and proven it that all of the QE that's happened since 2008 exactly equates to the interest payments from the previous cycle. That's Japan, that's the UK, that's Europe, that's the US.
And that concludes an insightful episode of Money TL Case. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.